Okay, so now that hopefully you've become an entrepreneur, you're gonna want to start investing. All right, so you have several ways to do this, and in this chapter, I'm gonna be very upfront with you about what I've done, and hopefully you will learn from it. So I don't know, everything. I'm not, I might be wrong. I'm not. I'm just gonna share my experience. I did rather well for myself, but you have to find what works for you. So today, so first you have real estate, okay? I bought my first property. I was 34, so not that early. That was actually, so that was in France, and so that was a rental investment. So I bought an apartment in Lyon that we renovated. So Lyon is like the second biggest city in France after Paris. So we renovated it. We actually split it in two, and we made two small studios for students. It's not a great investment. Like I will tell you about it. So my first investment was an apartment in Colombia. So the yield was 9%. So the yield, it's like the return on investment. So it's the yearly revenue divided by the total cost of acquisition. Okay. So in this case, the apartment in Colombia, it's an apartment in the small city where my wife is from. That was a new construction. We thought it was good quality. I wanted to invest. And the yield was 9%. It's an amazing investment because right after that, the oil crisis hit Colombia and the economy went down. The currency went down. So if I sell it today to convert it back into euros, I would sell money. I would certainly lose money compared to my initial investment. So it's just producing like Colombian pesos. When we go to Colombia, we have some pocket money. And that's what it is. I mean, it was like 50,000 euros. It wasn't big money. So I have the apartment in France. So the yield is 5.5%. And I used actually, so there is an author. She wrote a book about how she made money with the real estate. And this book became a bestseller. And people were reading the book and were asking her, okay, it's great. So how do I do? So she had a service where she would have like some people finding good deals for you and managing everything and charging a fee for this. And at that time I was living in Colombia with my wife. So that was perfect. But it wasn't a great investment. Like 5%, 5.5% yield. It's actually pretty bad. Actually, I have a buddy of mine who's a very successful French marketer. He's actually like suing her over this because he bought like 4 or 5, and he's not too happy. So, but I mean, it is how it is. Like, I'm gonna make like 50,000 euros over 20 years. So or maybe 100,000 euros over 20 years. So it's really not much, that's how it is. So then we bought an apartment in Portugal, and that has been so far our best investment because I'll tell you about it, but we bought it for 125,000 euros. Total cost was 155,000 euros. And it was bringing in close to 2,000 euros per month in revenue, right? So I'm going to show it to you, so you can see what it looks like. So it's there, it's on Airbnb. It's got an amazing view, on the city. So, what we did is that we actually, so you have a great view, on the city center. You have 4 rooms, and what we did is that actually, so we did a renovation, of course, like it was pretty old. You see the kitchen, the bathrooms, and so you don't see the we have a fourth. Oh, that's the one. Yeah, this fourth room. So it's funny because so to the right there, you have this view there. Okay, you have this spot. But actually, so that was like the living room. So what we did, so that's this room too. That's the same. So that's two different views. So what we did is that we actually built this wall, the wall that you can see here with the, so that's an internal window. It's funny, you know, it's because there was no other window. So we just put this wall. So it's a, you know, like a fake wall. We closed down the living room to create an extra room. So we added a fourth room for, I don't know if it's if it can fit two people. I think it's just one. So that's 7 people total. So yeah, that was the idea, you know. So we have this apartment. We bought 2 office spaces. The yield for each is around 9%. And then we bought our dream home. So we're gonna actually move in 1 month. So that's the house, you know. I'm super excited, of course. It looks amazing. I'm gonna be working there, you know. And yeah, it looks great. I'm so happy, you know. There are 2 living rooms. It looks like a little mansion. So yeah, the price is 1.4 million euros. We put in like 500,000 euros, and we are borrowing 1 million euros from the bank. So, you know, super excited about it. But as I wrote here, that's not an investment, you know. Yeah, over time, because people think, oh, you know, I'd rather buy my home instead of renting, because, you know, I will not like spend my you know, I will not like spend money for nothing, you know. In 20 or 30 years, I will have, you know, an asset. And they're right. But what happens is that if you look at the yield of such properties, like nice properties, even like, you know, like an apartment or a smaller apartment, but an apartment that is nice enough so you can live in, most of the times the yield is going to be pretty low, like 1, 2, 3, 4%. So that means that it's actually, so then it depends on the taxes, you know. But what we did when we arrived in Lisbon, Portugal, where we've been living for 6 years, is that we made this investment that was making almost 2,000 euros per month in revenue, and we were renting an apartment for 1,400. Okay, so you know, if we had bought the apartment where we were living, we would have spent close to 500,000. So instead of that, we spent a third of that, which is 150,000 euros. It was paying our you know, our apartment that we were renting, and we were getting a bit of extra money. So yeah, that's be careful of that. Of course, it's better to buy the house where you're living, you know, instead of renting over the long time. But it's even better in some cases to invest in a property and rent where you're living. Like you have, for example, like Ramit Sethi is a very successful online entrepreneur. He talks about a lot about personal finances, and you know, he lives in a condo in Manhattan, and he's renting, you know, and he's very upfront about it. He's like, yeah, no way I'm buying this, you know, it's just not profitable. So, you know, I prefer to invest in the stock market. So yeah, so I think that overall real estate is a bit overrated among investors. You know, sometimes you can feel that people think it's, you know, like the magic bullet. It is not. But yeah, it can be a good way to build wealth over time. So just to be upfront, it's important. I wrote it there. So the total value of these properties today, it's about $2.5 million. And I owe half of it in loans. Okay, so my net worth in real estate, it's about $1.2 million. Okay, just to be upfront, you know, so you know who you're listening to, what I did. Maybe you think it's good, maybe you think it's bad. I think it's okay. Yeah, so that's my net worth in real estate. That's about 1.2 million, and that's pretty much my net worth apart from my company, because this house was very expensive to acquire. So yeah, we put all our money in. We sold a little bit of stocks that I had. So yeah, all of our money is into real estate right now, which is, it's not diversified, it's not perfect, but that's how it is. We wanted to live in a home, and enjoy ourselves. So that's how it is. So I'm going to tell you about the pros and cons of real estate, and I'm going to give you my method to invest in real estate. So yeah, as I said, real estate is not a magic bullet. So the pros is you get leverage from the bank because you can borrow money from the bank. You have lots of market imperfections. That means that you can find like good deals, okay? And you can add value by spending time fixing properties, improving properties, managing them. For example, you see that with our apartment in Lisbon, we closed the living room and we made an extra room, because I was like, hey, you come to visit Lisbon, you're not supposed to be sitting on a couch watching TV. So this living room wasn't like very nice, and still we have a small area, right next to the window with a great view. So I was like, okay, you come to Lisbon, come out, get out, and go visit and eat at the restaurant, and yeah, you can still, eat, at that small table in the kitchen, or and spend time in the house. So it's a trade-off, okay, it's going to be less comfortable. We had some people telling us, oh, but we have kids, we need a place with the TV, where they can relax. And we're like, yeah, sure, maybe it's not the right place for you, but I think that overall the trade-off works, and we build value this way by closing the living room and creating an extra room. So yeah, you have ways to add value, be creative. Again, that's some advice I'm going to give you. Just follow some investors, look at what they're doing. It's not rocket science. So the cons, it's definitely time consuming. Looking for properties, it's a lot of work. Actually not that much, but yeah, it's some work. But then the financing, buying, the renovation, managing. And something that most experts never ever mention is that the more leverage you are, the more credits you have, the more risk you're taking on. So you have to be careful about it, right? If you're over leverage, you might be taking too much risk, and like sometimes like stuff happen, pandemics happen, like whatever happens, you can have downturns in the economy, and you have to be careful. You have to make sure that you don't take too much risk. So borrowing money is gonna increase your return on investment, but it comes at a price, which is it's increasing your risk, okay? Also beware, because low interest rates tend to raise asset prices. So that's something that, people never talk about, and it's so important. I strongly recommend watching the video by Ray Dalio that's called How the Economic Machine Works. It's very interesting, yeah, so just watch it. Like, I will put the link below the video, but it's very important, because most of the people are totally oblivious to this, and it is so important. And interest rates have been going down and down for years, and guess what? Asset prices have been going up and up for years. So I think it is completely related. And it means that you have to be careful. It's great to invest, but again, don't over leverage. It happened to many investors. They're starting investing, being successful. They're starting taking more and more loans, and stuff happen. You can get through a divorce. The economy can enter into a recession, and you need to be able to survive. So yeah, keep this in mind. So you have two key indicators to invest in real estate. So the first one is the price per square foot, right? So in Europe, that would be, the price per square meter. So that's the total acquisition price divided by the size. So that's super important. That's how I value properties. And like I showed you the house that we buying, and the price is just a little bit over 3,000 euros per square meter. Okay, which is really not much, like to compare prices in Paris, they're around 10,000 euros per square meter, but of course it's a different country, we live in Portugal, but like in the city center of Lisbon, prices for, because that's a new construction, it's like 2 years old, right? But like prices for new construction in the city center, they're like 8 to 10,000 euros per square meter, which is crazy because it's almost the prices of Paris when the average salary in Portugal is twice lower than the average salary in France. All right, so it doesn't make sense. But we looked at some, outside area. There is a famous beach city called Cascais, and it's very trendy, it's very posh, and prices were over 7,000 euros per square meter. And I was like, there is no way I'm buying a property, even though, for me, it's not an investment, it's for us to enjoy with my family. But I was like, there is no way I'm buying this because I think it's overvalued, it's ridiculous, And we found, so at the same distance, in an area that's actually, to me, that's even nicer. Like nature is nicer. It's very close to the beach. Cascais as well, but the beach there are even nicer. It's just because you have to go across the bridge. But because I work from home, I don't have to go to the city center every day. I don't care. So yeah, it's the same distance. Driving distance from Lisbon is 25 minutes. And the price per square meters is like 40% of the price in Cascais. So I was like, yeah, now I'm getting value for my money. This is very important. So I'm very happy about that because I was a bit desperate. I had been looking for a while. And even though for me it was an investment, I just couldn't buy a property like 150% more expensive. There was no way, I just couldn't. So yeah. Please, keep this in mind. And I think that, for this quality, 3,000 euros per square meter, that's a good price, because the house is huge. So you have the price per square foot. That's the first indicator. And the second one, that's the yield. So the yield, that's the yearly revenue divided by the total cost of acquisition. So the total cost of acquisition, that's the cost of acquisition plus the renovation. So my method to invest in real estate, you're going to see it's not rocket science, as always. So first, just follow investors online and see where they are investing, So it's funny because it's always the same advice, that I give you. Just like with the businesses, I'm not like, hey, try to invent something new. No, don't. That's risky. Just do what works, okay? So see what's working, see where they are investing, because you have different markets. You have, commercial real estate, retail real estate, offices, apartments, two-story buildings, individual houses. You have, different names depending on where you live and stuff. I would recommend investing in your local area. I think it's much better. So the apartment that I have in France, it's managed by a company, and even though, I don't know, I think it's better to be, and yeah, it's better to know the market and be able to go there by yourself and fix stuff. I don't know, I think it's just better, I don't really believe in investing far away. I know some people do it. I think that, I think it's not the best way, but then, So choose a market, my advice, in your area, where you live. So a market among what's working. And today it's great. Like you can follow investors on Instagram, on YouTube, and you can see where they're investing, where they're putting their money. So yeah, just follow what they're doing. So once you chose a market, so a kind of property, if you will, then follow the new listings closely. And each time you have a new listing, you calculate the price per square foot, right? So it gives you really, because it's funny, like sometimes you have people saying, oh, it's like if I told you like, would you buy this car for like, 10, I don't know, 50,000 euros? And you would be like, hell no. And then I'm like, yeah, it's a brand new Ferrari. Hell yeah, So you have to compare, and the price per square foot, for me, it's really the best indicator of, the price of the property. Because, yeah. So you can set up email notifications when a new listing comes up. Yeah, of course, the cheaper the price per square foot, the better. And be patient. It can take a couple of months before you find a good deal. At least, the good thing, because I remember before starting investing, when I started following investors online, I remember this guy was saying, oh, you should visit like 50 properties. I was like, yeah, sure, why not? It's important. But no, I don't think so, because you just have to be patient, wait for good opportunities, and then when you have a good opportunity, you have to jump on it, call right away, go visit it, and make an offer if you think it's good. But yeah, when we bought the apartment in Lisbon, I think we visited, I think it was like the fifth property we were visiting, so it's not much, and we waited for like 2 months. So yeah, it's totally fine. So I actually really enjoy the chase. Like it's like a search for a treasure. Try to enjoy it. It's exciting. Every time you look at a new listing that you can feel has some potential, it's very exciting. And yeah, take it like a game. And only visit properties that seem like good deals, where the price per square foot is low, is good. You can get an idea of how much it would cost to renovate it, and how much you can make out of it. Like you can do your math. It's pretty straightforward. It's not that complicated, and you can have an idea about like the return on investment. If it would be profitable or not. But be demanding. It's funny, like I remember when I was still looking for properties in Lisbon, and I was telling real estate agents like, yeah, I need a minimum 8% yield. And they were like, every time they were like, oh, but this kind of deal, it happens just, few times per year. And I was like, yeah, it's fine, like I just need one, I'm not gonna buy 10 properties. So yeah, be demanding, especially if it's your first deal. Be very demanding, okay? Don't settle for less. Like 5%, it's not enough. 7%, it's average. Above 7%, it starts being good. But then, of course, it depends how you manage it. Like if you rent it on Airbnb, then you're gonna have more expensive because you have more turnover, more cleaning fees and stuff. So yeah, so you're gonna need like a higher yield. Okay, so it also depends on that. So how do you make money in real estate? By solving problems, by fixing properties, by seeing value where others don't see it. Like, I sold a property in Lisbon and the seller, it's funny because yeah, he was like, oh, I'm gonna show you downstairs. There is a nice, a nice square with cafes, and we walked down there. And I got there, I was like, oh, this is just perfect. It looks gorgeous. You have some cafes. Tourists are gonna love it. And it was like a walking distance. It's like 15 minutes from the very heart of Lisbon. So I was like, this is great. And I knew that, like the acquisition price was 125. It would cost 30,000 to renovate it, and I was like, I know, because I knew the market. I was following the market. I knew that this would be worth renovated 200,000. So I knew that by buying it, we would be making 50,000 euros. And I was very excited about it because at that time that was like, that was like significant money for me. So you can build value by adding resources, For example, you take a property that's in bad state, you find a designer and a renovation company, and this plus this plus this, you're going to build the sum of these three assets. It's going to be more than the cost of each individual asset. That's really entrepreneurship. You take people, you take stuff, you take a factory, and then you're going to produce stuff that's hopefully is going to be worth the sum that the cost of these assets. So that's how you build value. So you can piggyback strong tendencies. So of course, Airbnb, it's a huge one, many city centers of touristic cities turn into kind of, like small hotels. So like it or not, it's an economic fact. And it was straightforward. I saw that in Lisbon. I saw the price of real estate. I saw the price of renting a night on Airbnb, and I was like, oh, this is a good deal, So again, in real estate, you make money when you buy. You need to buy at a good price. So that's why you need to be very, very demanding. Just go for the really good deals. So be patient. Also, you're going to need to build your team. For renovations, ask for quotes from several companies, at least 3. That's what we did. And it's funny because we had a Portuguese man, and he had been doing it for 30 years. For each meeting, he would show up, 5 or 10 minutes in advance, and the price was great. I was like, yeah, this is it. This guy, we can see he's reliable. And they did a great job. I mean, it's not like top quality, but it's totally decent. And compared to the price, it's great. And they are super reliable. They're not getting late and stuff. No, they're very serious. And a great tip that I'm going to share with you is that, because I've been hiring people, online, offline for years, I can tell you something. When a contractor looks messy, even before hiring him, guess what? Paying him is not going to change his behavior. It happened to me many times. I was like, oh, this guy is weird, he's taking a lot of time to reply and stuff, but, once I'm going to start paying him, he's going to straighten up, and that doesn't happen. People are the same. So watch for their behavior before you hire them, because it's not going to get any better after you start paying them. Which is weird, but most of the time that's how it is. So if you look at our apartment in Lisbon, it brought a 45% yield per year. So it's pretty insane. So look at this. So we bought it in 2015 for 125,000 euros, renovation plus furniture as well, 30,000. Total cost 155,000 euros. So the monthly income was 1,800 euros per month. That's 21,600 euros per year. So the yield is 13.9%. That's 21,600 divided by 155,000. Okay. So that's the yield. That's almost 14%, which is, it's pretty good. But we also have an increase in value because 3 years later, the potential value was 300,000 euros. And I'd say that's a very low price to sell it today. Actually, last year, right before the pandemic, I considered trying to sell it for 500,000, for people trying to get golden visas. And we could have, and then we decided, it's better to I mean, I'm not sure if we could have. I'm gonna be sincere. Maybe it wouldn't have worked. Probably wouldn't have worked. But I mean, the price before the pandemic was definitely over 400,000, and we decided to keep it because I like revenue. So the yield over a 3-year time period, if you take into account the money from the rent plus the increase in value, that's 209,000 euros. So that's 69,000 euros divided by 155,000. That's 45% yield, return on investment. So it's really good. But again, you see that I bought other properties, and it wasn't like amazing. So but it's also the way things are. Like I don't know if you know about the 20-80 rule, but it states that 80% of the results are going to come from 20% of your actions, and it's something that works like everywhere. So 20% of your investment are going to give you 80% of your profit. All right, so it's everywhere, and it's a rule of thumb, but that's how nature works. So if you look at my investments, I'm pretty sure that like 80% of my gain of my of the money I made come from 20% of my investments. Okay, so again, look at what's working in your area and do the same. Look at where investors are putting their money and just do the same. And if you're afraid, don't worry. It's good news. It means that you're alive. Being an entrepreneur, again, means making decisions and treat it like a game. Honestly, it's fun. I mean, if you have a job, don't you sometimes feel that, life is a bit boring? It's the same every day. Maybe it's not, I don't know. But if it is, just put a little bit of adventure in your life, a little bit of risk. Of course, don't take too much risk. Okay, I told you about it. It's very important. But so another way is the stock market. And I have to tell you, I don't have a lot of experience in the stock market because I've been investing mostly in real estate and in my business. It took me well over 20 millions in net worth. So, I'm fine with my choices. But I've studied the theory, and I'd like to share my views on the stock market. So the books that I read others, but these are really like the pillars. So you have the 4 pillars of investing by William Bernstein. And I think that this book is like from the 70s, and it's been, So there is a tip about books, you have so many books going out each year. And why would you take the risk to read a new book? I prefer to read the books that have been around for 10, 20, 30 years and that people are still buying, people are still talking about. They're editing new editions, okay? They're being updated. These are the books that you have to read. And this book, I think, is from the 70s, or the other one is more recent, but still it's like 15 years old. Irrational Exuberance by Robert Shiller. It's very easy because it was right before the dot-com burst in 2001, so I think it's 20 years old. So you see, it's not that young. And what the theory says is that, so it's mostly the first 2 books. I found that the content was pretty much the same. I don't know, that's weird, but yeah, that's how it is. And Irrational Exuberance, I think that's an interesting insight from someone who predicted the dot-com burst in 2001. I think he's a Nobel Prize of Economy, so I think he's a serious guy, And he's been right for 20 years, talking about the bubbles and stuff. So the theory says that you cannot beat the market. Day traders can't make money over the long run. I know that some people are going to disagree with me, and it's fine. Again, you don't have to, please question everything I say. I might be wrong. I might be whatever. But yeah, I really believe that day traders cannot make money over the long time. It looks like all the studies show that day traders cannot make money over the long run. And in my opinion, day trading is a bad business because you just cannot sell the business. Okay, you're not building a business. You're just like exchanging your time for money, which is fine, but it's not building a business. You are risking your working capital in a big way because it's. You have a lot of volatility. It's a lot of stress. I think that when you lost like even 1 or 2% in a day, at night you don't feel well, and it's not good. So the studies say that over the long run, even hedge fund managers cannot beat the market. Okay. So that's really exactly what the 4 pillars of investing say. That's the same in this book. And it's even worse because you have some fees. Okay. So not only they cannot beat the market, but then you have the fees. So investors are not doing great by investing money in hedge funds. Okay. And if you look at the people from The Big Short, it's funny, like people don't do this. Like you have the show about MasterChef, and you look at MasterChef and you see like they want to win, and they put, it's like their whole life depend on it. And I look at one season, I was like, oh, this is great, and if he wins, it's going to be successful and stuff. And then I was like, oh, this show has been running for 10 years, so let's have a look at what they become, the past winners. And you see that they did nothing. Like they're running a bakery in a small city. I mean, no, they're running a small business, but it's not like it changed their life. So it's so easy to look back and look at what worked. So much easier than trying to guess what's going to happen. So you look at The Big Short. It's a book by Michael Lewis, and it's also a movie. And you have 4 or 5 investors that got the 2008 crisis right, and they made money out of it. But for example, I went and had a look at, so I think it's Kyle Bass. It's like the guy from Texas. And since then, he made a lot of mistakes, He made like some wrong bets. He was wrong. So over the long run, because it's easy, you have people saying, oh, but the stock market, I made 15%. And you're like, yeah, over what period of time? 6 months, 1 year, 2 years. It's nothing. Like, we know that the stock market is going to go down, 10, 15, 20, 30% some years. That's how it is. That's how it behaves. So over a long period of time, so I'm talking 20, 30 years, only a handful of investors can beat the market. And most probably, you're not among them. I'm sure not among them. All right? So that's the theory. You can disagree with it. It's totally fine. Don't take question everything that I say. You might be right and I might be wrong, but that's what I think. So over the long run, so it's 30 plus years, you can expect a 7% return on investment, which is a lot. And people think, oh, it's not much. No, it's a lot. It's a lot because, so I read that article about, I think it was Procter & Gamble, or one of those, big like retail companies. I mean, selling basic products like Dove. He was talking about Dove. So that was this company. I don't know if it's Procter & Gamble or another one. You have a few. But anyway, it was like the CEO, and he was saying that to grow the revenue by 4% each year, it's like each year adding a brand like Dove, an extra brand of soap. And he say that growing by 5% instead of 4%, it's like adding the equivalent of the Latin America division every year. So it requires a lot of work. Okay, it's very tough. So most of the big companies out there, companies traded in the stock exchange, they grow by 4 or 5%. Okay, You have a few companies like the tech companies growing faster because these are, more like new markets. And you have a few companies going bust. So, in the long term, yeah, it's going to make 7% and it's pretty good. But so the recommended method, and again, you can read like Ramit Sethi's stuff. Like this guy is very smart, it's passive investing. Don't try to beat the market. Don't spend time, trying to beat the market. It's not gonna work. Just buy some ETFs. Try to have the same performance as the market, which again is roughly 7% yearly over the long term. And a rule of thumb is just like buy your age in bonds, the rest in stocks. So if you're 20, or hold 80% stocks, 20% bonds, because the stocks are more aggressive, more risky than bonds. And if you're 60, hold 40% stocks and 60% bonds. So it's just a rule of thumb, but and buy over time, for example, $100 per month, and then when you have more income, you can invest more. But that's what I was doing. I was investing 5,000 euros per month. I started when the pandemic hit because many companies, stocks got lost a third. So I thought it was the right time to start investing in the stock market. And since then, I sold everything. I didn't really make money because I kept these stocks for a short time, but didn't lose money. I didn't make money. We need the money to buy our dream house, so that's how it is. But you have a Vanguard, great company. Hard if you're in Europe. You have some apps like Robinhood. I mean, just make some research online. It's not gonna be. You're gonna pretty fast find the best ways to do it. So if you want to invest in an existing business, so you have the online businesses. So I invested about 200,000 euros. Okay, it's not dollars, it's euros, in my business to build System.io. And today, it might be worth 20 millions. Okay, I just need one buyer to be right. In my mind, it's closer to 30. Regarding our numbers, but I don't want to sell. I like what I do. I think I can grow it still a lot more, so it doesn't really matter. But it was a good investment. Again, you can buy a SaaS app like that's generating some revenue. It could be a good idea. And my recommendation, because there is an expert that was saying, oh, you can, create a portfolio of businesses like small apps that you buy and grow. And I think it's a bad idea because for each one of these apps in front of you, you're going to be facing some competitors, and most probably these competitors is going to be like their full-time business. So how can you win if you're fighting against someone who's dedicated, his entire days to his project? I think you cannot. So it's better to focus on just one business, make it successful, and you can maybe grow it, sell it. You have different ways. Like I remember, not so long, I listened from Spencer Howes. So I was on his podcast. He built a tool that I was a customer a few years ago that was called Longtail Pro. And in a video, he explained how he sold it for. So it didn't say the amount, but I guess it's probably around. So it was doing 1 million in revenue per year. But not growing anymore, and he sold it. So he didn't disclose the amount, but he said, if you know about software, you know about the multiples. And I was like, yeah, I'm pretty sure he sold it for, 4 or 5 millions, which is pretty good, So yeah, focus on one business. You have also offline businesses. So I wanted to tell you about my customer who has some franchises in Luxembourg. So he have 2 flower shops and 1 shop that sells tea. And it's funny because last year I called him and he was like, "Yeah, I bought a restaurant, you know." And I was like, "Really? You bought a restaurant? What a terrible idea!" I was like, "Wait, and this guy, when we talk business, we understand so well each other. That's why I like to talk business with him, because it was like, wait, I think I know what I'm doing, because it was a restaurant that was losing money, that was well located right outside of a Concert Avenue. So he bought it for 250,000 euros. And right before the pandemic hit, he took it to 20,000 euros per month in profits. And the potential value would be like 800,000 euros, right? So, but then I was like, okay, but a restaurant, aren't you supposed to be working like crazy? And because he's got this background in managing shops, he explained to me he fired half of the team, and so people who were not doing a good job, and he gave a raise to the other half. Okay, so to the people who were doing a good job, he got a general manager who's there to make sure that everyone is doing his best every day. And he was going there like 2 or 3 times per week, spending 5 or 6 hours per week. So it's pretty good for one business that's bringing in 20,000 euros per month. Okay, so again, there are opportunities. Too many people are trying to get a raise in the corporate world when it's I don't think definitely not the best way to get your freedom. Histories like this happen every day. Not to everyone, not all the time, but yeah, they do happen, and you can find some good deals. You just have to start searching. So my theory is that, so after not so many years, but a few years investing in stuff, my theory is that in the stock market, you can add any value. In theory, you hold some stocks, so you get to vote at the assembly, whatever. I don't know. I don't think that you're gonna have an impact. I don't think they care. You cannot, put in some work to, help the company, obviously, because you're not working there. You're just an investor. So, you can expect a return on investment of around 7% per year over the long term. So, in real estate, you have ways to add value. You have more ways, like by finding good deals, by negotiating, by renovating, by finding contractors, by managing properties. So you can expect to get a better return on investment, maybe 10 to 15% per year. Plus, of course, you have the leverage from the bank, right? You can borrow money from the bank, so you get a better return on investment because you own, compared to the money you put in, you're gonna get an even better return on investment, okay? Because most of the money comes from the bank. I mean, in some cases, in most of the cases actually. But then by investing in your own business, you can expect a better return on investment because of your expertise and the time you put in, So after purchasing the apartment in Lisbon, I was like, okay, so I could keep buying properties in Lisbon, or I could invest in my business and try to start developing this software. And I was like, what's my added value in real estate? Okay, we did it, we were successful, but it's not rocket science, we just looked for a good deal, bought it, renovated it, and we're managing it. But you have many expats with money, many entrepreneurs, Portuguese entrepreneurs working in real estate. So what's our added value compared to these guys? It's not much. And I was like, on the other side, I've been selling online courses online for 5 years. I have some expertise in digital marketing, copywriting. So yeah, most probably I should invest in my business so I can get a better return on investment. So it was hard. I really struggled for a year. I actually lost about 30,000 euros with a, first company to build a software that were like totally unable to deliver a good job. But in the end, I found some people I could rely on, and today my 200,000 euro investment might be worth over 20 million. So it's 100 times more. So of course, it's not every investment that's going to turn like this. It's just to explain to you my reasoning, why I did it this way. And I hope that it's going to help you achieve great success. So let's see you for the final part, the conclusion.